Welcome to Chapter 7. Uh, this chapter is entitled Accounting Information Systems, but what we're going to about really only touches, I guess, peripherally on accounting information systems. So what an accounting information system is basically a way to collect data, process those transactions into usable format, hopefully not doing it manually. It will increase efficiency, hopefully increase accuracy, and be far more cost conscious in terms of being able to operate. This seems so rudimentary, it's almost laughable at this point to even talk about what this is. But few systems operate anymore using or being reliant, I should say, on paper. But to the extent that paper starts off the transaction, that paper goes into an input device. There's my input device back there, which is my network scanner. Things go into the system and then into some sort of storage, and I guess the picture of the cloud is their way of saying, well, now largely everything's stored in the cloud. And well, I think that things are stored in the cloud. That's likely not the only place that they're stored in this data or era of data security and concerns about protecting personally identifiable information and data breaches and all that stuff. You want to have redundant backups both on site as well as in the cloud, because you just never know and you need to be prepared. That information also goes to output devices, my computer screen. I do very little actual real work on my phone. I find that not to be an efficient way of doing things. Within accounting systems, there are often a large number of subsidiary journals to capture more detailed information than can be gathered on the general journal. So you may have a sales journal, cash receipts, purchases, cash payments, in addition to your general journal. Now, while the journals keep track of things on a transaction by transaction basis, you're likely to also have subsidiary ledgers that keep track of things perhaps on a customer by customer basis or vendor by vendor basis. The most common ledgers you're likely to see are accounts receivable ledgers, accounts payable ledgers, and because we could have an accounts receivable journal that talks about all the accounts receivable transactions, but that's not going to give us any comprehensive snapshot view of any specific customer because it's going to be chronologically as opposed to by customer. These journals instead capture, there'll be a separate one for each customer or for accounts payable per vendor so that you can look and see all the transactions related to that customer or that vendor. And that is often really useful information. And this is just a graphic that talks in greater detail about what I just described. Now, if we were to add up all of the individual accounts receivable ledgers, for example, the total there should add up to the total in our accounts receivable ledger. And so what we owe or what we are owed in total for accounts receivable should be the sum total of what each individual customer owes us. And if that's not the case, you've got a problem somewhere. Most likely, if you're using a manual system, it's because you've not taken something from the general AR ledger and recorded it to the subsidiary AR ledger. But if you're using any sort of automated system, that should happen automatically. If it where you're more likely to have mistakes is maybe just entering the wrong customer information in there. So your totals might be correct, but your subsidiary ledgers could be incorrect because you've accidentally put the wrong customer number or name or something in there. And again, all of this can apply to accounts payable as well. So using these sales journals, as I said, we're going to be recording things on a transaction by transaction chronological basis. And what that does is allows us to look at a snapshot of particular types of transactions that are done on a chronological basis. We then move into drilling down into the ledgers to start looking at things specifically from again, a customer or a vendor view. So I think probably the most common words that students confuse at this stage are journals versus ledgers. You know, the journals are kind of the higher up view of things. The ledgers are the drilled down individual accounts or individual customer views, where you're going to see all of the Albert Company, for example, transactions. That's going to appear on a ledger, versus all of the sales are going to show up on the sales journal. You always want to do what's called prove your ledgers. So you want to make sure that, again, this sum total of all amounts on the subsidiary ledgers in fact adds up to the master ledger, the controlling ledger. So in this case, we've got the accounts receivable controlling amount, and do all of our individual customers add up to that? Hopefully, yes. If not, we've got to go back and see. If you're using an automated system, it's most likely because you've entered the wrong customer in there, because you shouldn't have to do repeated entry. One entry should cause the transactions to flow through to all of the appropriate locations. Otherwise, it would really defeat the purpose of having anything manual or automated, sorry. So if we don't have a ton of sales, we may just be recording everything in our general journal. On the other hand, if and I should say returns as well, if we have quite a few of those, we may want to have a separate journal to track specifically the returns and allowances, because that's something that you really want to keep an eye on. If people are returning a lot of stuff, that should be a red flag of something, either potentially defects in the process, but it can also be a sign of fraud. So you want to keep an eye out for that. Quite often you will see a cash receipts journal. That is very common because you absolutely want to make sure that you are tracking your cash, and whether it's cash from that you collect from customers through cash sales, it could be refunds that you get. If we bought something and we didn't like it and we refunded it and we got a cash refund, even if it's in a check, that would still show up in the cash receipts journal. So from the cash receipts journal, again, we're going to want to make sure that we post payments that come in to the individual accounts receivable ledgers, so that we can be sure that clients who pay us on account, when those payments come in and it gets recorded, in the cash receipts journal, that they also get credit for that individually. You also want to make sure that that cash receipts journal is always in balance. If you're using a manual system, this is really very important. So if we look over here, we've got all of these debit and credit columns on our cash receipts journal. What we want to do is make sure that the total of all of the columns that have debit balances in them and the total of all the credit columns, that balances. If it doesn't, we have a problem. So here we see how we added up all of the debits and all of the credit totals, and lo and behold, we are in balance. So we can trust that the cash receipts journal is at least in balance. It doesn't mean that it's correct, because we could certainly still have applied something to the wrong account, but at least the numbers, we didn't inadvertently only enter something in one column without, a corresponding second entry. And I'm going to actually stop here and hop over to the next video.